.25 seconds away from the opening bow this morning. Good morning to you. Pushing higher by 0.1% on the S&P 500. Tough day yesterday across the board for equities. On the Nasdaq this morning, bouncing back by 0.4. We'll talk about those numbers out of Netflix in just a moment. The opening bell in New York City rings. Switch on the board and get to the bond market. We look a little something like this on a 10-year. Yields up by 3 basis points. 4.9449. Very close to 5% a little bit earlier in the session on a 2-year maturity. 5-year, 10-year, 30-year. Take your pick. Cycle highs across the board in the last 24 hours. In the FX market, the dollar's shown a touch of weakness even with those moves in the bond market. The euro 105.67. We're positive on that currency pair by 0.3%. And easing sanctions on crude production in Venezuela. Crude pulling back just a touch, down 1%, $87 and about 50 cents. About 30 seconds into this session, a lift on the S&P by 0.2%, on the Nasdaq by 0.3. One stock to watch at the open, Tesla. Shares under pressure after dialing back growth expectations due to higher interest rates and cautious consumers. Elon Musk saying this: Tesla is an incredibly capable ship. We're not going to sink, but even a great ship in a storm has challenges. Eduardo has more. Morning, Ed.
Good morning, John. This is a big drop in Tesla's shares. At this level, it's on track for the biggest decline since July, now trading at its lowest level since August. The story is that it is a difficult environment out there, and if you look at the sell side or analyst response, a number of firms have cut price targets, and of course now starts the re-evaluation for forecasts for 2024. But the read across between them is that expectations going into this quarter for Tesla were low. What came out in terms of financial results in the quarter gone was even lower than those low expectations. Adjusted EPS 66 cents a share. The forecast was 74 cents. The story of the year has been price cuts, and we've seen how that's impacted the bottom line. On the top line, revenue of 23.4 billion was below the 24.06 billion in sales that analysts were expecting, but the key metric that you watch is automotive gross margin excluding regulatory credits. That data point came in at 16.3%, which is the lowest level in 4 years, well below the sort of floor that previous CFO Zach Kirkhorn had put in place. And now starts the debate about valuing Tesla as a car company or as a technology company. Wall Street was looking for automotive gross excluding reg credits of 17.7%. I think you and I are going to talk later in the show about the bigger picture narrative from Musk, the growth trajectory, but this is a big move lower in Tesla, down 6%, biggest drop since July.
That valuation question is the question. Ed, thank you, sir. Down 5 or 6%, as Ed pointed out. Here's a view from the south side. Wedbush, Dan Ives doing this, cutting the price target to 310. Here's the quote: "We would characterize last night's conference call as a mini disaster. The street wanted to get their arms around the falling margins and constant price cuts. Instead, we heard from a much more cautious Musk, focusing on higher interest rates and the difficult path for Cybertruck production." The latest there from Dan Ives of Wedbush. The stock lower this morning. In early trading in the first 2-3 minutes of the session, down by something like 5 to 6%. We're down 5.3% currently. Your second story, in the other direction, Netflix raising prices after posting its best quarter for sub growth in years. The company writing this: "We've shown that with discipline and a focus on the long term, you can build a strong, sustainable streaming business." Abby has more. Hey, Abby.
Hey, John. Investors really like what they've done with the past quarter and the outlook. The stock is soaring, having its best day right now since January of 2021 at the highs at the open, up 18%. At that point, the best day since October of 2016. So a big reward here for these results. And what investors are really honing in on is the big subscriber add. 8.76 million subscribers were added in the third quarter, blowing out analyst estimates, and it's also one of the best quarters for subscriber ads in years. Now, why it is so important, it puts them on track to add 20 million subscribers subscribers this year. When you compare that to 9 million in 2022, well, it's more than a doubling. It shows that their password crackdown is working, and they're also saying that their strong content is really helping out the results, so much so that they have confidence to raise prices, as you mentioned, by $3 to $23 for its big plan here in the U.S., the basic plan by $2 to $12. They will do similar raises in both the U.K. and France. A couple of analysts on the street, John, very excited and positive on this. Morgan Stanley upgrading the shares of Netflix to an overweight, also raising the price target to $4.75. Big upside there. And Truist upgrading to a buy. Netflix absolutely soaring on the day. Big results out of the streaming company.
396 in early trading and still climbing. Abby, thank you for that. Let's stick with earnings. Las Vegas Sands authorizing a $2 billion buyback program. The CEO saying this: we were pleased to see the recovery in travel and tourism spending. We remain deeply enthusiastic about our opportunities for growth in the years ahead. Katie has the story. Hey, Katie.
Hey, John. Yeah, there's two factors that's pushing Las Vegas Sands higher this morning. First, of course, the third quarter was a beat, but it's really that $2 billion share buyback that's really driving the stock higher this morning. This is the first buyback since 2020, and of course, this follows Las Vegas Sands reinstating its dividend last quarter, which had also been halted in 2020. So you take those two together, and it's really a clear signal of management's confidence here. You take a look at what the sell side is saying. Citi noted this morning that the buyback shows that management believes that where the stock is trading right now does not reflect the company's fundamentals, while Barclays called it, quote, a nice surprise, and noted that the third quarter results were better than feared. All of that clearly working through the shares this morning. You take a look right now, currently almost 4% higher, though I'll note it's still lower on the year, John.
Katie, thank you. Up to 46.26. Let's turn to the telecom space. AT&T raising its annual free cash flow guidance after topping mobile subscriber estimates. The CEO saying the following: we're gaining profitable customer relationships and becoming more efficient. This is powering our strong business performance. Simone Foxman has this one. Hey, Simone.
Hey, John. Yeah, the beat and raise here, driving shares up higher, the most since July on an intraday basis. A lot of the focus was around the full year cash flow outlook that it was able to increase. Now seeing a full year cash flow at about $16.5 billion versus the $16 billion that was anticipated. This speaking to the success of the company's cost-cutting program, also able to raise earning guidance here. All of this, though, on the back of those gains in subscribers. 468,000 net new mobile subscribers in the third quarter. That's well above estimates, and that's after 4 consecutive quarters of declining subscriber growth. You know, there's a lot of competition and broader headwinds in the industry, especially AT&T just lagging the 5G network build-out that the likes of Verizon and T-Mobile have done. It has a heavy debt load, and we still don't know what the costs are going to be of cleaning out the lead from its old copper phone network. But Citi here saying this strong growth in postpaid subscribers is a positive net data point for the industry. We seem to be watching Verizon shares rally a little bit in sympathy, and this, mind you, is before the accounting for a lot of those iPhone subscription sales and promotions that we saw at the end of September. So maybe a little bit more positive news ahead, and that's why we're seeing this 6.4% jump.
Big gain. Simone, thank you. The latest about 7 minutes into the session. In the equity market, positive here by 0.1%. On the Nasdaq, up by about 0.2. In the bond market, plenty taking place. I've said this a few times today. Cycle high on a 2-year yield, on a 5-year, 10-year, 30-year, all of the past 24 hours. Currently, yields up at the long end, just a touch on a 30-year by a couple of basis points. Call it 3 basis points higher, just north of 5% on a 10-year, getting closer and closer to that line in the sand over the last day or so. That 5% line, 4.94. Yields up a couple of basis points right now. Stifel's Barry Bannister seeing limited upside for equities over the next 12 months, right in this. Our view remains that the S&P 500 peaked in the summer of 23 and see mid-4,000s through the middle of 2024. Barry, I'm pleased to say, joins us right now. Barry, fantastic to catch up, sir, as always. For people not familiar with your call, let's work through it together again. Why do you see that peak back in the summer and limited gains, muted price action for the year ahead?
Yeah, we got off the bullish train in the summer of 23. Our view is 4,400 at year-end this year, and it's actually new information. We think 4,400 all the way through the middle of 2024. The problem has always been the normalization of interest rates. If you look at the 10-year real yield, the Treasury Inflation Protected Security, or TIPS yield, when it burst through 2000, the market ran into through 2%, the market ran into trouble. It went to 2.5, and if you look at the TIPS yield equivalent for the 45 years prior to the year 2000, it was 3%. 2000 was a seminal year. It began 5 deflationary shocks in 20 years. Now the Fed is leaving that deflation behind. We're normalizing rates. If we go to a 3% TIPS yield, it keeps pressure on the price-earnings multiple of the market for a prolonged period of time.
Barry, is that a bigger problem for certain parts of the markets versus others?
Yeah, sure. Long duration, what we call long duration equity or higher PE multiple growth stocks, their valuation suffers more as that real 10-year yield goes up, the TIPS. On your Bloomberg, it's USGG T10Y. And if you look at that yield going up, it's going to keep pressure all the way into next year, towards the middle of the year, when we have to start worrying about some of the economic data possibly weakening, unemployment crossing over 4%. These would be precursors to recessionary concerns in the back half of 24.
So Barry, back end of 24, to have those concerns, you're just pushing them out. Lots of people just pushing out these concerns to the back end of maybe next year. Barry, with that in mind, is there a window here to look for some kind of cyclical rebound that you can get exposure to in stocks?
Yeah, what we've been saying is essentially a pair trade. So long cyclical value, short cyclical growth. So what is that? Cyclical value is energy, capital goods, financials, transportation, materials. Cyclical growth, the short, would be things like media, entertainment, semiconductors, tech hardware, and autos. So that's Alphabet, Meta, Nvidia, Apple, and Tesla. So you're long short on a cyclical basis. And what happens is you get a cyclical rebound. The PMI manufacturing, we think it goes over 50 soon. The industrial production has been strengthening, no recession on the cyclical side. And the other thing to consider is the sticky inflation. The precursors of inflation, like wages and commodities, they don't look so bad to us. We think that they'll stay aloft, no recessionary decline. So when you get that cyclical rebound, sticky bottoming for inflation, you really want to be in a more cyclical profile, and the growth stocks are just, continuously hammered by that rising real yield as the Fed normalizes the long end of the curve.
Barry, I was reading some of your work. You seem to acknowledge one threat to the cycle: energy. Is energy the hedge here for you?
Well, energy is kind of a call option on a tight market. The geopolitics have really filtered into energy. I mean, Saudi Arabia could decide tomorrow to bring the price of oil down, but they've chosen to keep it up. Now, $80 to $90 a barrel, they're probably satisfied. But if you poke up towards $100 a barrel, they could easily increase production and lower the price. So they're being rational actors here in terms of the way they're acting. The irrational side, the one we don't really understand, is what would happen in 2024 with Russia, maybe Iran, on the oil front. Remember, Russia has a presidential election, I believe it's March of 24, and we have one in November of 24. Peak summer driving season is the summer of 24. Their best option from a game theory perspective would be to cause oil to skyrocket into the summer and fall of 24. So higher oil prices with energy stocks is a little bit of a call option on that, not to mention that it's just a sort of a cyclical group right now because it's a demand story relative to supply.
Hey Barry, good to get your views and an update from you and the team. Barry Bannister there at Stifel. We're about 12 or 13 minutes into the session. I just want to mention where crude is. Brent 90.84, WTI 87.69, negative by about 0.7%. Coming up, Tesla earnings missing the mark.
Tesla had a disproportionately large share of the market because it did have first mover advantage. But first mover advantage does not last forever.
Pierre Ferragu of New Street Research joins us next with more on Tesla's disappointing quarter. A conversation coming up.
There are a lot of other car companies out there that can make electric vehicles, and Tesla had a disproportionately large share of the market because it did have first mover advantage. But first mover advantage does not last forever. It does not afford a permanent competitive advantage. You got to keep running to stay ahead because people are coming after you. And what we're seeing is that the competition is catching up. And Tesla is forced to lower prices and deal with lower margins, just like other car companies.
Tesla earnings missing estimates. The CEO Elon Musk discussing some of the challenges, saying this: "We dug our own grave with the Cybertruck. Special products that come along only once in a long while are just incredibly difficult to bring to market and to be prosperous." Ed Ludlow has more. Hey, Ed.
Yeah, there's a lot long-term to recalculate and reconfigure here. Interest rates was very much top of mind for Elon Musk. To give a specific example of how that manifests itself, Tesla has plans to build a new factory in northern Mexico in Monterrey. And what Elon Musk said is that they will sort of decelerate that process. They cannot go full tilt, is how he put it, and that expansion generally will pick up pace if and when interest rates decline. It's one of these things where suddenly you have market analysts going back to looking at the dot plot and Fed futures funds to work out, Fed fund futures to work out, what the trajectory is for this company. In terms of their response, right, a lot of focus, as we discussed, on automotive gross margin, excluding regulatory credits, coming in at the lowest level in 4 years. They are focusing on cost cutting internally, according to the engineering chief, Lars Morave. And then there's the biting off more than you can chew element, right? The Cybertruck is already 2 years delayed. It will ship starting November 30th, but it's going to take a period of 2 years, according to Musk, into 2025 till they're shipping at volume. A lot of narrative out there about how bad this earnings call was from an investor's perspective, going back to sort of 2018 times. A lot of people focusing as well that Zach Kirkhorn's departure as CFO is now more of a concern. That's a really interesting question to pose to some investors out there.
Ed, thank you, mate. Appreciate your coverage over the last 24 hours. Pierre Ferragu of New Street Research joins us now. Cut the price target down to 300, maintaining that buy rating. Pierre, let's get straight to it. Given the direction of margins and where things are heading right now, the question I hear a lot this morning, Pierre, how to value this company? Like any other automaker, what is it?
Yeah, it's a very good question. So if you look at the last 12 months, Tesla reduced its average selling price, so you can roughly translate that into cut prices by a bit more than 15%. Gross margins came down by just over 10 points. So that's definitely a painful journey, let's face it. What's interesting is that it's not so much a question of competition or anything like that. I hear a lot of comments around that. I think it's very misinformed comments. The only reason why Tesla has been cutting prices that aggressively is because you have less people buying cars, and it's an elastic market, and so you need to reduce prices, not because your competitors are hurting you or taking share from you, but because you want to continue to grow and find buyers. So what's interesting in these maths, you take prices down 16% and you have your gross margin coming down 10%. That means underlying that you took your cost down by 4 points, 4%, average cost per car and cost of goods sold. And that's really what's happening. So Tesla is cutting prices much faster than they can reduce costs. But the good thing is that these price cuts, they'll find a bottom at some point. And what maybe the company kind of telegrammed last night is we're going to see a stabilization, and if we slow down our growth, that's all right in the end. And the thing is that when prices start slowing down, like the price decline starts slowing down, I think like the underlying cost cuts, 4 points a year, 1 point a quarter, is extremely sustainable. And this is really what maintains Tesla in a unique position in the market, because they really have an ability, by introducing their new batteries, their new form factors, their new manufacturing technologies at a pace that is unprecedented in the industry. They have the ability to maintain their cost leadership and improve it over time. And so, to answer your question, sorry, it's a long-winded answer.
No, it's okay.
like
it's a big question.
Ultimately, Tesla will get back, between 20 and 25% gross margin in autos. And when you're asking, how do you value them? I, take the revenues today, I plug in like a 22.5% gross margin. I look at what kind of earnings that reflects in 2024, and I'm looking at the multiple on that, and $300, it's 40 times that. So it's a very safe valuation. Paying 40 times earnings, normalized earnings for a business growing very fast, I think is a good, low end of the valuation range. And that's where I think the stock is going to trade for some time, because it will take time, for hopefully interest rates to come down, or consumers to adjust to it and come back to the market with the new reality of how much it costs to own a car, or more time for prices to come down even more to really trigger that increased adoption. But on the fundamental story, the fact that Tesla is a massive cost leader and a massive product leader in the auto industry, and that where they still have single-digit market share, it's still there. So it's still a very good growth business, and a business that has an extremely strong and defensible right to make money in this industry.
I've got about a minute left, Pierre, so I want to squeeze another question in if I can. No, by all means, I think it's the question. There isn't really any other. But I do want to talk about demand for EVs right now. Pierre, what is going on at the moment? You hear about all these unsold EVs piling up elsewhere. What is happening? What's your read on things?
Yeah, I think Elon articulated that very well last night. When you look at how much interest rates have grown, the total cost of ownership of a car today for normal people who have to pay on a monthly basis for their car through a loan or a lease, has gone through the roof. And if anything, I'm surprised the broader auto market is not suffering more than it is today. And I expect the broader auto market to meet more and more disappointing demand. The reason why we haven't seen that much of a broad pullback in autos is because we've been running very, very low on dealer inventories and things like that. So the industry is readjusting to that.
It looks brutal. Pierre, they're screaming at me.
It's going to be brutal.
I'm going to save more time for this conversation next time. Pierre Ferragut on the latest with Tesla. That stock is lower from New York. This is Bloomberg.
That all day yesterday.
From New York, here's the trending diary. Fed Chair Jay Powell speaks at noon Eastern. Goolsbee, Barr, Bostic, Harker, Logan speak later. The House expected to hold a third vote for the speakership, and President Biden addressing the nation at 8 p.m. Eastern Time. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
the financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Thursday, October 19th. Here are the top market stories that we're following for you at this hour. 10-year at 5%, so now what? Almost at 5%. The curve moves towards a pancake where all yields top 5%. We're going to take you live to the Economics Club of New York for an exclusive interview with Fed Chair Jay Powell. And high rates sting Blackstone. Profit sinks 12%. Stock down 4% today. President John Gray says the Fed is having real success on inflation. And the earnings clouds roll in. So Tesla dials back growth expectations. American Airlines cuts its forecast. Sun shines, though, for Netflix, raising prices as subscribers pile in. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, after that initial jobless claims number, I really did expect the 10-year to be at 5%. We're not quite there yet.
We're nearly there. We're nearly there. And we get more data now, which is interesting. You said to me in the break, just before we came to air, Guy, you are going to break the existing home sales, aren't you? And I kind of muttered something. I don't really care about the existing home sales number anymore. Here's the reason why. This is a broken market. The effective rate in the United States for people that are paying mortgages on existing homes is about 3.5%. The headline rate is 8%. This is why people aren't moving. This is why this market is broken. I think this is the lowest number we've seen since 2010. Alex, let me just move my cursor. Existing home sales come in at 3.96. That's down from 4.04. It's not a good number, but it doesn't really tell us anything other than the fact that a lot of people, like Alex Steele, locked in very low rates, and now they're not going to move.
Yep, and to be fair, a lot of the times I talk and you just kind of grunt. So that that was in keeping, I think, with okay. So to that point, market's not moving at all on this, really. You're still seeing yields back up a little bit in the long end, and stocks pretty much go nowhere. So our big story of the day, Fed Chair Jay Powell will be speaking at the Economic Club of New York in just over 2 hours' time. He'll be sitting down with Wall Street Week anchor David Weston in an exclusive interview, and David joins us now. And I can attest, because I sit right in front of you, we sit next to each other basically, that you've been prepping this for like a month.
Yeah, I have, asking as many people as many questions as I can, but there are current themes.
You want to make news, he does not want to make news.
Yeah, exactly.
So what are the themes you're going to be working on?
Well, it's not like we've never heard from him before, right? Mm-hmm. Everybody wants an answer to the one question, which is what are they going to do in November? That's the one question he's not going to answer. So the question is, what can we get from him? And we're going to talk about a lot of things, Alex, you and Guy have just been talking about, which is where we are with the 10-year, and by the way, the 30-year as well, what's going on with mortgage rates. What is his theory of the economy? Why is the economy so resilient? We saw it again today with jobless claims. We saw it yesterday with retail sales. Why is it so resilient after he's raised rates so much?
David, this is going to sound like the wrong question to ask, but let me ask it anyway. Does Powell matter at the moment? I'm wondering what is moving that 10-year, that 30-year right now. Is it Powell? Powell's already raised rates. We know that he's raised rates aggressively. He may raise rates a little bit more, but not very much more potentially. The real question is, why is the market moving the 10-year up to 5%? Why is the 30 already at 5%? Is it other factors at the moment? What impact do you think Powell is having at the moment?
Well, certainly I think we all would agree Powell still matters. He is first among equals on the Federal Reserve. They do set monetary policy. They have a lot of power. But your general point is exactly right, and I intend to ask him about this. Do they have less influence, actually, over monetary policy than they used to, because there are all those other factors, including, by the way, geopolitics and the amount of money the U.S. government's borrowing. They do have influence on one thing, which is whether they're buying treasuries, which they're not doing anymore, which may be exacerbating the problem with the long end of the curve.
Yeah, and this is when David comes up to me one day, it was a couple weeks ago, was it? And you're like, let's talk about the term premium, which for David to say that was pretty awesome. So I'm sure that that's going to come up too. So just basically, we're going to be structurally higher no matter what the Fed winds up doing, which brings in things like fiscal policy, the deficit, what's happening in D.C.
Right, the Speaker of the House, the uncertainty about that. And a question I have is, are bond vigilantes at least starting to peek their heads up above the parapets right now once again? Because clearly people are getting a little nervous, I think, about how much money the government's borrowing. And to your point, Alex, are they going to pay it back? When we don't have a Speaker of the House, we're going to have to borrow more money for defense, given what's going on right now in Israel as well as Ukraine. I think the bond markets are getting a little nervous about repaying all that debt.
David, we better not keep you any longer. You have things to do. We're really looking forward to this. It's going to be fantastic. Everybody is going to be tuning in to David's interview with Chair Powell.
Yeah,
it's
no
happening at the top of sort of, basically in 2 hours' time. There's no pressure here, David, but we all assume that it's going to be fantastic. Honestly, it's going to be great. Thanks for stopping by. Thanks for updating us on what we're going to be talking about. David Weston, Wall Street Week. What a day. Okay, let's talk a little bit more about what is happening here with these markets. We're nearly there on the 10-year. We've nearly got a 5% yield. You go further along the curve, you've got a 5% yield. John Gray, the Blackstone president and COO, speaking to our own Sonali Basak a little earlier on, talking about the Fed's progress on inflation.
The Fed is really having some real success today. The Fed is going to stick at this. So I do think they're going to hold rates higher for longer. The long end has now accepted that. And I think that's going to have the effect of slowing the economy, slowing growth.
We're going to hear more from that interview a little bit later on in the program. Sonali will be with us as well. It does take us, though, to our question very nicely. Do you buy bonds at 5%, or is there more still to come here? Do we know if Powell is Volcker or Burns at this point? Well, let's try and ask all these questions to Ira Jersey, our chief U.S. rate strategist, joining us from Bloomberg Intelligence. Ira, what do you think? It looks like we're going to get there. Say we get to a 5% 10-year. Is that a buy?
Well, I think it depends on who you are. Do you buy a little and keep a little powder dry in case we get up to 5 1/4? I think that might be something that a lot of investors would consider. Our view has been, and to answer what you were just talking about before, Guy, is we estimate that around 92% of this recent move in 10-year yield since July has actually come from the expectation that the Fed's not going to cut very much, even when it does cut. So, we think about what happened to the terminal floor. The market was pricing for the Fed funds rate in 2025 to be 2.5%. Now it's pricing for that only to be 4%. So it makes sense that you have to have some average of what the Fed funds rate is going to be priced into the 5-year, 10-year, 30-year bonds. And I think that we're getting close to that now. But it wouldn't surprise me at all to see the 2-year and the 10-year get back to zero at around 5 1/4, 5.2% over the next couple of weeks. And there probably is a time to buy. It just might be just slightly early.
So, Ira, that brings us to sort of the pancake curve that we've been talking about. And you've been bringing this up for a very long time, where everything is kind of over 5% and we're not really steeper, we're not really flatter. What's the impact of a pancake curve?
Yeah, so I think the impact is not as significant as you might think. I think what's going on with the economy is everyone's now reassessing what the economic environment is going to be in 2024, and it seems like the chances of a recession are significantly lower. The Fed is probably going to remain on hold for all of 2024, if not even longer than that. So because of that, the whole market kind of has to get flatter. Now, overall, over a long period of time, that will affect things like the weighted average cost of capital for businesses, and it will slow the economy. So when we talk about these long and variable lags, I think the longness of that variability is showing itself, and in the structural changes that have happened in the economy and the way that we finance ourselves. So eventually Fed policy will work. We will slow the economy significantly. It's just going to take a long time. Another thing, Alex, I wrote this morning in a note on the Bloomberg terminal right now, is that money market funds are also throwing off an extra $22 billion of interest every single month compared to what they were doing 18 months ago. So that's that's a pretty big bump to potential spending, where that could add 1% to GDP if all of that interest were spent by the consumer and business sector that's receiving those interest payments. So interestingly, the people who say that higher rates might actually be fueling the economy a little bit, they might not be that wrong.
It depends what your outgoings look like. Depends if you've got more savings than debt, I guess, is the question around that. Ira, do we yet know if Jay Powell is Volcker or Burns? You've lost me? Can you not hear me anymore? Alex tries to do this on a daily basis. Ira Jersey may have just succeeded in doing it. I think we can... there you go.
I just turned off my IFB. I'll just take it out. That's actually the perfect thing to do.
It's sort of selective deafness. Selective deafness is maybe what they call it as well.
All right, Ira, listen, thanks a lot. We appreciate it. We look forward to that piece in the terminal also. Ira Jersey of Bloomberg Intelligence. So coming up, more on that question of the day, do you buy bonds at 5%? We're going to talk to Mark Connors, 3IQ Corp Head of Research, coming up next. This is Bloomberg.
Today, the Economic Club of New York hosts a conversation between Fed Chair Jay Powell and Bloomberg Wall Street Week's David Weston. Recession risk, inflation outlook, real estate amid high rates, and more. The live interview happens today at 12 p.m. Eastern on Bloomberg. Context changes everything.
I think long rates have now moved quite a bit. And so that's going to lead to some tightening here, further tightening. But what investors want, of course, is a bit of stability. And I think ultimately we will find at some point some stability in marketplaces, particularly in treasuries. When that happens, I think you will start to see transactions pick up again. They are at a muted level, but it doesn't stay like that forever.
That was John Gray, Blackstone President and COO, speaking to Sonali Basak earlier on Treasury markets. So that kind of leads us to the question of the day. Like I said, I really thought we'd be at 5% on the 10-year right now, but the question still holds. Do you buy bonds at 5%? With us now is Mark Connors, 3IQ Head of Research. Mark, it's good to see you.
You too, Alex.
What do you think? Should you buy bonds?
I love the front end, and that's like the safe walk in the warm water part. But with the amount of dislocation that's happening in the long end, because Japan's buying their bonds, the Treasury, we know the Fed, we'll find out more from David on his talk today with Powell, what they're doing, but they're selling bonds. And so who is buying bonds? And on your terminal, you can look at this indicator for bond volatility called the MOVE Index. We've talked about it. It is up still around 130, which is like, I would say, 50 on the VIX. So imagine we're talking today and the VIX is, say, 45 or 50. We would be having a different conversation. Bonds are quiet. No one understands them. So we're in a time of dislocation in bonds. So do you buy at 5? As long as you're okay owning it at 7%, you can buy it at 5. That's why we like the short end.
Okay, Mark, great to see you.
Hey,
Always
Guy.
a pleasure. Are we going to 7%? Do you think there's a better entry? Do you think there's a better entry point? Do I average in between 5 and 7? What's the tactic here?
If you have a bond portfolio now, you're going to still ladder. You have 5, 10s, 30s, et cetera. So you'll just do that. For the new person looking to allocate some equity into 5 because they think it'll fund their retirement or et cetera, I think you have to stay away from the 30-year, and I think you have to stay in that. You're getting 5% from the T-bills. So short end still, Guy. Yeah. That's what I think.
So it also raises a good question. First of all, MOVE Index would equate to 50 at the VIX is a very sobering statement. So I'm wondering, if bonds are not a safe haven, then what is? We were asking that question yesterday.
Oh, is that a leading question? Because
it's a little bit of a leading question.
Yeah.
Mark's going to talk about Bitcoin for a second and gold.
So let's start with gold. Gold had last week a 5.4% move, 3.4% on Friday alone. It's only done that 2 or 3 other times in the last 3 years since COVID started. It did it when we first launched the interest rate move on March 4th of 2022. It did it again when the dollar had that blow-off move in November of 22. And it did it again when the banks, on March 17th, when we had the failure of the banks. So clear haven, and now we're at it again. So yes, people are buying gold because that is an anti-30-year move to buy gold. It means that I think inflation's coming. I need to have a store of value. And yes, Bitcoin's 10% move Friday on Monday on a false flag move on an SEC approval per Larry Fink. It's an indication of the pent-up demand. People will be buying Bitcoin when that ETF comes. So there it is.
Mark,
thanks for that layup.
We try. A swing and a hit. You've addressed 2 areas that people are seeking safety in: gold, Bitcoin to a certain extent, and the front end.
Yes.
Is the front end, how would you rank, if you are, what is the safety trade right now? Is it just put everything in cash? I'm sure it's not. But how should you think about how you diversify between the various areas of the market that you consider to be relatively safe right now? How much should you be putting into each of these? How much volatility are we going to get between them? How much correlation is there going to be between them?
Okay. So the correlation between equities and bonds hit a 30-year high in August of, I'll say, 85%. I mean, back to the 90s. So that's why, as far as leverage in the system, leverage strategies, hedge funds haven't done that well this year. Companies that cash flow, equities are still a core holding, have to be. And we talked a little bit about this before, Alex, when we were setting up. This is a period where companies made money in the prior 15 years in a low inflation environment, financial leverage and operating leverage. That's gone. In a higher rate, higher cost environment, you have to have a company that can operate and reshift all of their cost of goods, et cetera. So what does that mean? It means the larger boats are going to float better as we transition to a higher for longer period.
So here's the interesting thing I find is that obviously small caps, based on that thesis, have gotten wrecked.
Yes.
But then you get data that continues to come in solid, like, say, retail sales, and then if you're short, you get smoked. So how does that make sense?
So I think that's positioning. So I think people are short those companies, and they're short, and then something, I think there's a short squeeze on a lot of them, especially when you're talking about, 5 to maybe $15 billion market caps. It sounds like a lot, but it's not when you look at the broader market. So absolutely, and that's why what you just said is why hedge funds are up 2% this year on the long short side, because they had the right idea, but the earnings came in poor, but they got squeezed, they had to cover, and they lost money. So the stock train isn't indicative of the health of those small caps, I think.
It's fascinating, isn't it? Just kind of what's happening and the push-pull within the market. Final quick question, Mark. Let's assume that 5% is the new normal. 5% 10-year. That's what the cost of capital is.
Yep.
We can argue about the kind of the minutiae around that. How long does it take the economy to adjust? How long does it take the financial markets to adjust to a 5% world? How far through that process are we?
That's a great question. I didn't think of that, about how to answer that. The knee-jerk reaction, I think, is the Fed's job, we know, is, and I'll start Fed and I'll go to the consumer. The Fed's job is to control prices, price stability and full employment. But they have a third mandate, and that's market stability. And the MOVE index tells us that it's not stable. So I think we're going to drop on a forced technical move if Treasury auctions fail and there aren't buyers. So that's the first time it does it. On a more organic, system-wide basis, that's harder. That's like economics. That's establishing, do people change their behavior and say, I like buying in, I like income now. But if income, a 5 and 6% guy, isn't funding your kid's college education, which grows at 8% a year, so I think we haven't answered that question. We don't have the information on whether the economy will accept and buy bonds at 5 and 6%, because it may not serve.
That's just a thoughtful point. And we saw with the 20-year auction, 30-year auction too, the buyers just aren't coming in the same way. Mark, always good to see you. Thank you so much, Mark Connors of 3IQ. Thank you. All right, still ahead, we're going to get some earnings reports here. Tale of two. We got Tesla tempering growth expectations. Netflix just blowing it out of the water with subscriber growth. We're going to break down those results next. This is Bloomberg. It is 22 past 7 on the West Coast. We want to get to the startup where we cover the top tech stories from the Bay Area and beyond in Silicon Valley. Starts its morning. Joining us now, Bloomberg Technology co-host Ed Ludlow. Let's get to Tesla first. Not a good morning if you're a shareholder, but what did you make of the quarter and the commentary?
Yeah, the world is tough out there, and Tesla's not immune to the things that the rest of the market and the rest of the industry is immune to, right? You know, Elon Musk talks a lot about interest rates, but the story of 2023 was price cuts. That clearly hit the bottom line, right? Adjusted EPS well below expectations. But the key metric the market watches is automotive gross margin, excluding regulatory credits, right? That came in at 16.6%, which is its lowest level in 4 years. And down from the sort of high 20s to 30s that we're used to with Tesla. And I guess that goes to the more academic question of, is Tesla a tech company or is it a car company? Well, on the financial results, it's a car company.
Yeah, don't look at the multiple then.
Yeah, exactly.
Yeah.
Ed, Cybertruck. If the F-150 Lightning is struggling, what effects is that going to? What should we think about the Cybertruck?
Well, you know, the Cybertruck is a supply-constrained product in that the immediate demand far outstrips Tesla's ability to ship. And that's the story, right? This is a product that's 2 years delayed. I'll never forget being in Los Angeles for the unveil, you know, the infamous moment where you throw the ball at the window and the glass cracks. But it's going to be a much slower process than everyone thinks. November 30th is the launch. And what Musk said is that it won't be until 2025 until they're producing in volume of around 250,000 units a year. And I'm paraphrasing, but you know, he basically said we bit off more than we can chew. New products are really hard.
Which I appreciate the honesty on that, which is why compared to say OEMs, they at least have their very profitable gas cars that they can kind of live off of while this is happening versus Tesla that doesn't have that. So how much more does the multiple need to re-rate for that?
Well, also, remember that Tesla reiterated that it will deliver around 1.8 million vehicles this year. It's still the market incumbent, and it, by choice, cut prices to try and protect growth. It's just that strategy is in question a bit on the growth front. And on the multiple, don't forget all of the AI-related work that Tesla tried to talk up during the call. A lot of the modeling that the street is doing is based on that future, which is heavily software-related.
Ed, the question then becomes, just to come back to this whole issue of the multiple.
Yeah.
If this is the direction of travel, what does the market do with that? If these are the numbers, what does the market do with that? We've never understood what Tesla is. Is it an AI company? Is it a Bitcoin company? Is it a car company? Whatever you want it to be, it can be. Do you think we're consolidating finally around this idea that it is a car company? And if that's the case, when do multiples really reflect that?
On the gross margin, yes, because they're now, especially if you take into account, you know, you strip everything out, they're basically in line with Ford and GM, right? The vision is this, a future where they have a new generation model, which we don't know much about, that Tesla basically centrally controls as a robo-taxi fleet. That is the far distant future. The business model entirely changes. It's predicated on a world where we don't necessarily own our own cars, and Tesla controls the physical asset and the service. It's just that right now, when you're an investor in this stock, bearing in mind the current multiple, that is really hard to envision, especially when the CEO is talking about how hard the rate environment is and how they can't grow until rates come down.
Yeah.
Great stuff. Ed always appreciates this stuff.
We didn't even get to Netflix. Netflix did some stuff. It was cool.
I know we didn't. I know we didn't get to Netflix.
Too much news.
Too much news. It's a good thing. We like news. We're in the volatility business. Yeah. Okay, coming up, existing home sales are down, falling to their lowest levels in 13 years. That's the story on the retail front. What about what's happening in the commercial space? Angie Solanki, Collier's US Retail Director. We're going to talk about CRE next. This is Bloomberg.
about an hour into U.S. trading session. Yes, there are individual movers, particularly around earnings, but on an index level, we're again very calm. Abigail's tracking the moves for us. Abigail?
Yeah, very small moves indeed, Alex, and it is kind of surprising given some of the bigger movers beneath the surface. The S&P 500 at this point flipping lower. Earlier it had been higher, similar to the NASDAQ 100, although it looks like the big tech index is going to follow the broader S&P 500 lower. One index that is undeniably higher, that of course is the New York FANG index, up 1.1%. Let's take a look at one stock that is helping all three of these indexes, but that FANG index in particular, and that of course is Netflix. On the day, the last time I looked, I think up more than 15%. At the highs, up 18%. At that point, the best day since 2016. That of course on a good quarter with subscriber ads that beat. The outlook looks pretty solid. They're raising prices. Tesla, on the other hand, is down. So on the week, you can see Netflix up 11%, Tesla down 14%. The implied volatility on both of these stocks into the earnings report, not disappointing. We have that kind of volatility, a tale of two cities, and of course Tesla, there's an issue in terms of them missing profits by about 10% and margins a bit weak. Now, one pressure on stocks overall, and we continue to have volatility, of course, rising rates, just really incredibly high here over the last month. That 2-year yield out of 522, you have the 10-year yield not so far behind, and then that 20-year yield above the 2-year yield. So you have this flattening yield curve that folks are trying to make sense of. The question is, did the big inversion, does that mean that a recession is ahead? Some might think that it is. There's so much volatility here for bonds that while we do have stocks down, and we should note that the Russell 2000 deeply in a correction, the S&P 500 well off of its July high. In blue, this is the volatility on TLT, or that longer bond ETF, and then here's the volatility on the ETF SPY, and you can see that bond volatility is outperforming stock volatility, Guy.
It's amazing to see what is happening here. The vol story on the stock story, I find it absolutely amazing, but it was interesting to hear what Mark Connors had to say about what the MOVE index will be signaling if the VIX was as elevated as the MOVE, 50. That would be an amazing number. Abigail, thank you very much indeed. Okay, let's move on and talk about what is happening in the housing market and also in the commercial real estate market. So US existing home sales come through at their lowest level in over a decade. Basically, what you've got here is a lot of people on very low mortgages that they locked in a few years ago. Mortgage rates are now very high. They're not going to be moving, as a result of which that market is effectively broken. What impact, though, are we seeing from these very high interest rates into the CRE market, the commercial real estate market, and particularly the retail end of that spectrum? Angie Solanki, Collier's National Director of US Retail, joins us now. Collier's an investment management company, $98 billion under management. Angie, it's great to see you. There's so many competing forces that I'm fascinated by in what is happening with the retail story at the moment. Clearly, we have a consumer that has a job and a consumer that is still willing to spend, and the retail sales numbers therefore reflect that. Yet at the same time, retailers are having to deal with significantly higher rates, managing costs that are going up as well. How does that all come together when it comes to CRE retail?
It's a great story to kind of dig into and understand, and I have to say what retailers are really looking at is they're really focused on how they take this portfolio and right size it. So as we've seen right now, we've seen definitely changes in the retail CRE market. Specifically, I'll bring up Rite Aid with their current bankruptcy. When we look at their bankruptcy, what they're really trying to do is right size that portfolio. They're trying to get to a point where it becomes efficient to operate stores. So stores that are in a footprint that makes sense for that market or that community, and where they can staff it appropriately. Mm-hmm. We all know prices are going up, like you said, labor's going up, and much more. So these retailers are trying to figure out what is that ideal footprint, and we're seeing that from IKEA, Macy's, Target, and others.
Where are we in the process of pricing, say, commercial real estate? Like, when do we get to the trough and we can start build back up? I mean, where are we in that?
So in terms of sales itself, if you look at the investment side, capital markets, you definitely are seeing a slowdown, right? People are being cautious. It's not cautious as it relates to the actual retail industry itself. I think people and investors are still bullish in that market based on sales. And if you look at those specific retail properties whereby you're looking at more that grocery drug anchor, those are your essentials. Those are doing very well. You're looking at retail product in the suburban markets faring quite well. well. Sales growth, occupancy, all very stable. When you're looking at more the urban, more dense locations and markets, they're going to definitely have a slower recovery, but there's still interest. And there's interest coming in, but at, of course, call it softer or discounted evaluation.
Angie, I think you're being very polite there. Subprime retail. Subprime retail, can it be repurposed? I'm hearing a lot at the moment about subprime office and the fact that there's the possibility of repurposing some of that. Does that apply to retail as well?
It does. If you look at projects that are, stale, that haven't really moved or changed in terms of merchandising, so maybe it has an anchor tenant that is no longer viable in that market, we are starting to see a lot, investors or developers coming in. So what I mean by that is that they're looking at these projects and they're saying, hey, this is an opportunity to convert this. And we're seeing the conversions occur in mixed use. We're seeing conversions occur in life science as well as multifamily. So there's still demand and growth. There is unfortunately a little bit of a ramp-up period, right? So from an entitlement perspective, but people are still putting, they're investing and they're willing to wait.
Angie, when you take a look at the bond market, we were talking today about, okay, it's 5% 10-year almost. Do you buy it? Someone said, well, no, but maybe it's 7%. It looks pretty good. And I guess it just leads to the point of if rates keep getting higher and higher because of structural issues, what's next to break in your world?
It is at some point, there's capital out there. People want to invest. We are definitely seeing movement, quite a bit of movement in the single, triple net space, so single tenant space. There's a high activity there. There's actually lack of supply. So, and there's a lack of construction or new construction. So that coupled is an area that we are focused on to see if that starts to shift. The other area is that at some point when these investors are looking at their 5-year, 10-year hold, and they've come or met that 5 or 10-year hold, they need to make some decisions here. So I think we're going to be monitoring this to see what occurs in the next 3 to 6 months.
All right, Angie, thanks so much. Really appreciate it. Angie Solanki from Collier's National Director for U.S. Retail. We really appreciate the insight. So coming up, we're going to get back to the markets, back to earnings. American Airlines actually up despite having lowered their forecast. We're joined now by, we will be joined by Sheila Kayoglu, Jefferies Aerospace, Defense, and Airlines Analyst. This is Bloomberg.
We're going to talk about what's happening with the airline sector in just a moment. I want